You think financial collapses are accidents, don't you? Random acts of economic God, unforeseen black swans swooping in from the chaotic void. You envision panicked traders, algorithmic glitches, a domino chain reaction nobody could have predicted. You see the headlines screaming, unprecedented, unexpected, shocking. And for a moment, maybe you buy it. You sigh, you shrug, you move on, convinced that these seismic tremors are just the cost of doing business in a complex world. Let me tell you something, my astute, skeptical friend. You've been sold a beautifully orchestrated lie. A narrative woven by the very architects who either built the house of cards or conveniently looked away as it was being constructed. Because financial collapses, the truly epic, civilization-shaking ones, aren't accidents at all. They are, in fact, the meticulously engineered, slow-motion detonations of a perfectly calibrated machine. They follow a blueprint, a formula, a perverse, almost elegant sequence of events that, once you see it, becomes chillingly predictable. And today, we're going to dissect that formula. We're going to peel back the layers of myth and denial, journey through the Roaring Twenties, the dizzying dot-com bubble, the housing frenzy of the early 21st century, and show you the identical, recurring patterns. We'll expose the core ingredients for the perfect collapse, tracing their evolution from the ashes of 1929 through the wreckage of 2008, and then, with a cold, hard stare, we're going to cast our gaze upon the horizon of 2025. Because if history doesn't rhyme, it certainly screams in echo. And what it's screaming right now, my friend, is a warning. So, let's rewind. Way, way back. Before the internet, before even television. To a time when the world was trying desperately to forget the blood-soaked trenches of the Great War. The year is 1919. Europe lies in ruins, its industrial heartland scarred, its young men decimated, its treasuries plundered. Empires have crumbled, maps have been redrawn, and an entire generation is grappling with what it means to rebuild on top of a mass grave. But across the Atlantic, one nation emerged not just unscathed, but grotesquely enriched: the United States of America. America, previously a debtor nation, was now the world's undisputed creditor. European powers, desperate for reconstruction, for food, for raw materials, looked to Wall Street for salvation. The war had supercharged American industry, transforming it into a global powerhouse. Suddenly, the US wasn't just making goods for its own burgeoning population. It was fueling the reconstruction of an entire continent. Gold, the bedrock of the global financial system, flowed across the Atlantic like a river, piling up in American vaults. The stage was being set for an unprecedented economic boom, but also for a colossal miscalculation. The Roaring Twenties weren't just a cultural phenomenon of flappers and jazz. They were an economic revolution powered by credit. Lots and lots of credit. Suddenly, everyone could buy a car, a radio, a refrigerator, things that were once luxuries for the very rich, on installment plans. Buy now, pay later wasn't just a marketing slogan, it was the mantra of a new era. Consumer debt, once frowned upon, became a badge of modern living. Factories churned out goods at an astonishing rate, profits soared, and the stock market began its dizzying ascent, fueled by an intoxicating blend of innovation, optimism, and pure, unadulterated greed. This was the first critical ingredient in our formula, a period of sustained, seemingly unstoppable economic expansion, driven by new technologies and readily available, cheap credit. It creates an illusion of perpetual growth, a societal belief that the good times will never end. The underlying reality, of course, is that credit-fueled booms are inherently fragile. They're built on borrowed time, quite literally. The Federal Reserve, barely a decade old, found itself in an unenviable position. Created to stabilize the financial system, it was now trying to navigate an economic landscape unlike anything seen before. Should it rein in the rampant speculation, or risk stifling the booming economy? The prevailing wisdom, or perhaps the prevailing delusion, was that the stock market boom was a reflection of genuine economic strength. Any attempt to pop the bubble, they feared, would only cause unnecessary pain. So, they mostly stood by, occasionally nudging interest rates, but never quite pulling the emergency brake. Meanwhile, Europe was stuck in a financial purgatory of its own making. Germany, crushed by reparations demanded by the Treaty of Versailles, found itself trapped in a vicious cycle of hyperinflation, only temporarily stabilized by American loans, primarily the Dawes Plan and later the Young Plan. The logic was perverse. America lent money to Germany, Germany paid reparations to France and Britain Britain then used that money to pay back their war debts to America. It was a perfectly circular flow of credit, an elegant financial merry-go-round, as long as the music kept playing. And the music, of course, was American money. This global interconnectedness, this intricate web of debt and dependency, formed another crucial ingredient: the amplification mechanism. A problem in one part of the world could no longer be contained. It would inevitably ripple outwards, thanks to the very financial innovations designed to facilitate global trade and recovery. Think of it as a series of perfectly arranged dominoes, each one poised to knock over the next. But while industry roared and stocks soared, a quieter, more insidious problem was festering. American agriculture, which had boomed during the war supplying Europe, now faced a massive oversupply and collapsing prices. Farmers, heavily indebted from wartime expansion, were staring down the barrel of ruin. Their pleas for help were largely ignored, dismissed as a sectoral problem, a minor glitch in the grand economic symphony. It was the crack in the foundation, dismissed as a superficial hairline fracture. The stock market, though, was the real spectacle. Everyone, and I mean everyone, seemed to be getting rich. From the shoeshine boy to the titans of industry, the market became the ultimate get-rich-quick scheme. You didn't even need capital. You could buy on margin, borrowing up to 90% of the stock's value from your broker. It was like magic. Put down a tiny bit of your own cash, watch the stock price climb, sell, and pocket the difference. What could possibly go wrong? This mass participation, this widespread belief in a new era where old rules no longer applied, where assets only went up, where everyone was a genius investor. That's another non-negotiable component of the formula. It's the psychological fuel that propels the bubble to stratospheric heights. Rationality is thrown out the window, replaced by FOMO, the fear of missing out, a powerful siren song that lures even the most cautious into the casino. Everyone was confident that they could get out before the music stopped. Nobody believed they would be the last one holding the bag. The smart money, the real insiders, they saw the warning signs. They saw the absurd valuations, the unsustainable credit growth, the underlying economic weaknesses. But they were either too invested in the system, too afraid to speak out, or quietly positioned themselves to profit from the inevitable downturn. Their silence, their complicity, was deafening. They were, in essence, the engineers turning the screws, tightening the pressure valve, knowing full well the boiler was about to blow. The stage was set, the cast assembled. The perfect collapse was almost ready for its grand debut. The year is 1929, and the fuse is burning short. The autumn of 1929 was a season of gilded delusion. The market, a frantic beast, kept clawing its way higher. Each new peak hailed as proof of America's unshakable prosperity. But beneath the surface, the cracks were widening. On Thursday, October 24th, the first tremor hit. A wave of selling, small at first, then a torrent, sending prices tumbling. The ticker tape, usually a steady stream of green, turned scarlet. Panic, the market's oldest and most irrational emotion, began to whisper, then to shout. The titans of Wall Street, the J.P. Morgans and the Mellons of their day, tried to stem the tide, pooling resources to buy up stocks, a desperate, valiant attempt to show confidence. Spoiler alert, it didn't work. It was a band-aid on a gushing arterial wound. Black Monday, October 28th, arrived like a plague. The selling intensified. The market shed over 12% of its value in a single day. Then came Black Tuesday, October 29th, the day the bottom truly fell out. A staggering 16 million shares traded hands as investors frantically tried to offload their holdings, often for pennies on the dollar. The sheer volume overwhelmed the system. Ticker tapes ran hours behind, leaving people buying or selling blind. The speculative pyramid, built on borrowed money and blind faith, imploded. Margin calls, the cruel mistress of leverage trading, went unmet. Fortunes evaporated in minutes. The shoeshine boy who was giving stock tips suddenly found himself penniless, along with millions of ordinary Americans who had poured their life savings into the market, convinced that this new era meant endless riches. They were the ones left holding the bag. The initial reaction from the powers that be? Denial, mostly. President Herbert Hoover, a self-made man who believed in rugged individualism, initially downplayed the crisis, calling it a temporary halt to prosperity. Bankers issued reassuring statements, hoping to calm the storm, even as their own institutions began to buckle under the strain of bad loans and plummeting asset values. The Federal Reserve, still finding its feet, made a series of critical missteps. Instead of injecting liquidity into the collapsing system, it hesitated, then tightened monetary policy, fearing inflation where deflation was the true monster. It was like fighting a raging fire by turning off the water. And this is where the amplification mechanism, the intricate global web of debt we discussed, sprang into action. As American banks and investors faced ruin, they did the only thing they could. They called back their loans. Remember that perfectly circular flow of credit? America lending to Germany, Germany paying reparations to France and Britain, who then paid America? That merry-go-round abruptly shuddered to a halt. The music stopped. Germany, already struggling, plunged into an economic abyss. Its banks failed. Unemployment soared. Political extremism, already simmering, found fertile ground in the widespread despair. The dominoes began to fall, not just across Europe, but globally. Trade, already struggling under the weight of anemic demand, received a knockout blow with the Smoot-Hawley Tariff Act in 1930. Designed to protect American farmers and businesses by imposing steep tariffs on imported goods, it backfired spectacularly. Other nations retaliated with their own tariffs, igniting a global trade war that choked off international commerce. Exports plummeted, factories shuttered, and unemployment, already a growing problem, metastasized into an epidemic. The idea that a nation could simply wall itself off from global economic pain was revealed to be a dangerous fantasy. It only ensured that everyone shared in the misery. The Great Depression wasn't just a stock market crash, it was a societal cataclysm. As businesses failed in droves, people lost their jobs, then their homes, then their dignity. Soup kitchens became a common sight. Hoovervilles, shantytowns named with bitter irony after the president, sprang up in cities across the nation. Farmers, already reeling from oversupply, saw their lands foreclosed upon, adding to the exodus to cities that offered no work. The psychological scars ran deep, fostering a generation of extreme caution and distrust in financial institutions. The widespread belief in perpetual growth, in the new era, was brutally shattered, replaced by a pervasive sense of fear and scarcity. The Federal Reserve, paralyzed by its own dogma and internal disagreements, stood by as thousands of banks failed, wiping out the savings of millions of ordinary Americans. The very institutions designed to provide stability became sources of further instability as bank runs became commonplace. People, desperate to save what little they had, rushed to withdraw their money, often finding the doors locked shut. This was not merely a downturn, it was a systemic failure, a complete breakdown of trust in the financial system itself. The credit markets seized up, investment vanished. The engines of the global economy sputtered, then died. The formula had worked perfectly. Unchecked speculation, fueled by cheap credit and mass delusion, built an unsustainable bubble. A fragile global financial system, interconnected by debt, ensured that the collapse would spread like wildfire. Policy blunders, driven by denial and flawed economic theories, amplified the initial shock into a prolonged, agonizing depression. The silence of the smart money, the complicity of those who saw it coming but did nothing, contributed to the colossal scale of the catastrophe. The grand debut of the perfect collapse had been a resounding, terrifying success. The world would spend the next decade in its shadow, wondering how such a profound tragedy could have been allowed to unfold, and, more importantly, if it could ever happen again. The world would spend the next decade in its shadow, wondering how such a profound tragedy could have been allowed to unfold, And, more importantly, if it could ever happen again. The answer, of course, was yes, but only after humanity, bless its optimistic, amnesiac heart, had a chance to collectively forget the hard-won lessons. After the dust settled on the Great Depression, reforms were indeed enacted. Glass-Steagall separated commercial from investment banking. The FDIC insured bank deposits, and the Fed was given more tools to stabilize the economy. The aim was to build a safer, more resilient system. For a few decades, it mostly worked. But the memory of pain fades. The allure of easy money never does. And the regulatory guardrails, once so strong, slowly began to corrode under the relentless pressure of innovation and lobbying. Fast forward to the early 2000s, and the stage was being meticulously reset for Act 2, 2008. The formula, refined but remarkably similar, began to churn. Again, we saw a period of sustained, credit-fueled expansion, this time centered not on industrial output, but on real estate. The internet had promised a new economy, a dot-com boom and bust, but the underlying mechanisms of financial alchemy were about to get a terrifying upgrade. Cheap credit, thanks to persistently low interest rates, flowed like a river through the global financial system. Lending standards? They became a quaint suggestion rather than a rule. Anyone with a pulse, and sometimes even without one, could get a mortgage. No income, no job, no assets, loans, or ninja loans as they were charmingly called, became a real thing. It was 1929's buying on margin, but for your house, and for millions of homes across the nation. The new asset for mass speculation was housing, of course, but the real genius was in what Wall Street did with those mortgages. They bundled them, sliced them, diced them, and repackaged them into complex financial instruments, mortgage-backed securities, then the truly ingenious collateralized debt obligations, or CDOs. These opaque Frankenstein monsters of finance were sold to institutional investors worldwide, often rated AAA by the very agencies who pocketed fees for the privilege. The delusion was that housing prices only ever went up, that these derivatives were so diversified they were impervious to risk, that the smart money had engineered a system of perpetual profit. Everyone was in on it, from the construction worker flipping houses to the global pension fund buying CDOs. The interconnectedness was immense, a global web of toxic assets masquerading as financial innovation. When the subprime mortgage market began to wobble, the amplification mechanism kicked in with a vengeance. Banks worldwide held these ticking time bombs. The initial reaction, once again, was denial. Ben Bernanke, then Fed chair, famously claimed the subprime issue would be contained. Spoiler alert, it wasn't. The Federal Reserve, caught between stimulating growth and managing inflation, kept interest rates too low for too long, fueling the housing bubble. When they finally started raising rates, the music stopped. Homeowners with adjustable rate mortgages saw their payments skyrocket. Foreclosures surged. The value of the underlying assets in those CDOs plummeted, turning supposedly safe investments into radioactive waste. Lehman Brothers collapsed, not a black swan, but a brightly plumed, screaming eagle, visible for miles, if only you chose to look. The government stepped in, not to let the system cleanse itself, but to preserve it at all costs through massive bailouts. The too big to fail doctrine was born, cementing moral hazard into the very bedrock of our financial system. The silence of the smart money was deafening until they were the ones receiving the bailout checks, of course. The world pulled back from the brink, scarred but seemingly unbowed. We were told lessons were learned, regulations tightened. Dodd-Frank was enacted. But beneath the surface, the core elements of the formula remained, evolving, adapting, waiting for their next grand performance. So we learned our lesson after 2008, right? We fixed the system? We inoculated ourselves against the perfect collapse? Ha! That's adorable. Because if history doesn't repeat, it certainly screams in echo. And right now, the echoes are deafeningly clear, pointing straight at 2025. Look around you, my friend. The ingredients for the next perfect collapse are not just simmering, they're boiling over. Let's start with the debt. The United States national debt is not just approaching $35 trillion, it's climbing faster than a SpaceX rocket on a caffeine binge. We are effectively operating on a never-ending credit card, constantly raising the limit, convinced the bill will never truly come due. Interest payments on this gargantuan sum are now projected to exceed defense spending, crowding out vital investments, and turning a significant portion of our tax dollars into a perpetual tribute to past borrowing. This isn't just about the government. Corporate debt is at historic highs, propped up by years of ultra-low interest rates. Zombie companies, those that can only pay the interest on their debt but not the principal, are roaming the economic landscape, waiting for the first stiff breeze to blow them over. And you, the consumer? Your credit card debt is soaring, auto loan delinquencies are rising, and student loan burdens continue to crush a generation. The entire system is levered up, to the eyeballs, in a way that makes 1929 look almost quaint. Then there's the Federal Reserve, the central bank. After 2008, their response was unprecedented. Quantitative easing, or QE, printing trillions of dollars to buy government bonds and other assets, and keeping interest rates at effectively zero for over a decade. This artificially low-cost money inflated an everything bubble, from stocks to real estate, creating a generation of investors conditioned to believe the Fed will always ride to the rescue. The Fed put became an unwritten rule. If the market stumbled, the Fed would be there to catch it. But then, inflation, initially dismissed as transitory, decided to stick around like an unwelcome relative. The Fed was forced to reverse course, implementing the fastest and most aggressive interest rate hikes in decades. This sudden shift from a decade of ultra-cheap money to rapidly rising costs is like slamming on the brakes of a speeding car. Something is going to break. We're already seeing cracks in commercial real estate, where empty office buildings and rising interest rates are a ticking time bomb for regional banks. The Fed is a juggler trying to keep a dozen chainsaws in the air while riding a unicycle on a tightrope over a volcano. And they just lit one of the chainsaws on fire. And inflation, my cynical friend, is the silent taxman, quietly picking your pocket every single day. It isn't just rising prices, it's a slow-motion transfer of wealth, eroding your purchasing power, making it harder to save, and disproportionately hurting those at the bottom. The persistent fear of a wage price spiral hangs heavy, a specter from the 1970s. For governments burdened by massive debt, inflation is a stealth default, devaluing what they owe. But it's a brutal mechanism for everyone else. Now, let's talk about that intricate global web of interconnectedness. The global financial system, long anchored by the dollar, is starting to fray at the edges, pulled by competing gravitational forces. The rise of the BRICS nations, Brazil, Russia, India, China, South Africa, now expanded to include Saudi Arabia, Iran, UAE, Egypt, and Ethiopia, is a direct challenge to the dollar's hegemony. Calls for de-dollarization, for alternative reserve currencies, are growing louder. The weaponization of the dollar through sanctions has only accelerated this push. If the world loses confidence in the dollar, or if major trading blocs begin to bypass it, the implications for American borrowing costs, global trade, and financial stability are profound. This isn't just a trade dispute, it's a foundational shift, another amplification mechanism just waiting for a spark. And what about the mass delusion? The belief in a new era where old rules no longer apply. This time, it's AI. Valuations for tech companies leveraging artificial intelligence are soaring to dizzying, arguably absurd heights, reminiscent of the dot-com bubble. This time it's different, they say, because AI will truly change everything. Perhaps. But the underlying mechanics of speculative excess, FOMO, and the rush to pour capital into unproven business models remain eerily familiar. Crypto, while offering genuine innovation, has also served as a vast casino for speculative excess, market manipulation, and regulatory uncertainty. And remember those smart money players? Are they quietly exiting, or are they simply doubling down on the narrative, knowing full well they can escape before the music stops? Their silence, their complicity, is once again deafening. The blueprints are laid out. The historical parallels aren't just rhyming, they're practically identical. Unchecked speculation, fueled by cheap credit and mass delusion, built an unsustainable bubble in 1929 and 2008. Today, we have government, corporate, and consumer debt at unprecedented levels. We have new technologies like AI and crypto, driving speculative frenzy and a belief in endless growth. We have a fragile global financial system, interconnected by debt, geopolitics, and supply chain fragility, with the added risk of de-dollarization. And we have policymakers, the Fed and governments alike, stuck in an impossible bind, their past actions now limiting their future options. The question isn't if the music will stop, but when, and how many people will be left standing when it does. This isn't about fear-mongering, it's about pattern recognition. It's about understanding the game so you're not just another pawn in someone else's perfectly engineered collapse. Because knowing the formula is the first step, perhaps the only step, to ensuring you're not part of the equation when the final calculation is made. If this video gave you value, hit like, subscribe, and share it with anyone who appreciates this kind of content.